Every single day, Wall Street just drowns us in a sea of noise. But we're here to find this signal. We've distilled a top strategist's daily brief to figure out what the big money is actually doing, not just what they're saying.
And this one line, right here, this is the entire story of the day. You had positive momentum coming out of Asia, fighting against a whole lot of scary headlines from Washington. The market had to pick a side, and well, it did. Let's dig into why.
So that brings us to the most important question we have to ask every single day. How do you tell the difference between what matters and what doesn't? It's like a puzzle. Our job is to ignore the distracting pieces, the noise, and find the real signals that show us where capital is truly flowing. And here it is, in black and white. This is the perfect example of today's conflict. On the left, you've got the noise. China might sell US treasuries. Sounds terrifying, right? But on the right, you have the signal, a massive, real $100 billion flow of cash into AI. The market's choice between these two tells us everything we need to know. Just look at that number, $100 billion. That's not a tweet, it's not a headline. That was the actual demand for Alphabet's bond sale for their AI infrastructure. When you see a wave of money that big, you have to pay attention. That is a signal you just cannot afford to ignore. And that massive AI signal wasn't happening in a vacuum. There were other things backing it up. We had a pro-stimulus election win in Japan, which basically gave a green light for risk-taking globally. The White House was smart. They got out ahead of a potentially bad jobs number, so it wouldn't be a shock. And the market? Well, it saw right through the China threat, recognizing it for what it is, just part of a long-term strategy, not some new panic.
Now, this is where it gets really interesting. This rally wasn't just the usual suspects, the big tech giants pulling everything up. Sure, the Nasdaq was up 1%, but look at the Russell 2000, the small cap stocks, also having a strong day. This is what we call market broadening, and it's a sign of a much healthier, more sustainable rally. It's not just a one-trick pony. Okay, so that's the 30,000-foot view. Now let's follow the money. Let's get down on the ground and see exactly where the big institutions were putting their chips today.
This table breaks it down perfectly. No surprise, technology was the place to be. Money was just pouring back into those beaten-down software and AI stocks. The hottest theme was clearly AI infrastructure, thanks to that huge Alphabet deal. And on the other end of the spectrum, healthcare got hammered, but it was really because of a full-blown crisis at one particular company, which we're about to get to. And if you want a perfect case study for the AI infrastructure theme, look no further than Oracle. Yeah, Oracle. A company a lot of people wrote off as old tech is suddenly back in the spotlight as a critical player in the AI build-out. The result? A nearly 10% jump in a single day.
So what exactly lit the fuse here? Well, it was a triple threat. First, the market had a eureka moment and realized Oracle provides some of the essential plumbing for AI. Second, good news from OpenAI's funding lifted the entire sector. And finally, a Wall Street analyst upgrade basically forced everyone else who was sleeping on the stock to wake up and buy.
Okay, now let's look at the other side of the coin. For every hero, there's a villain, right? Well, today's villain was Hims and Hers. The stock didn't just fall, it absolutely cratered, down more than 17%. And listen, this was not just a bad day. This was a potential game-over situation. They backed away from a huge growth driver, these weight loss drugs, because they were facing legal threats and regulatory heat. The key takeaway here is that Wall Street is now questioning their entire business model. This isn't a dip to buy, this is a 5-alarm fire. All right, so that's the what. Now for the so what. The most valuable thing you can get from any analysis is a clear plan for what to do next. So let's look at the two key scenarios that this strategist is preparing for. Okay, first up, the bull case. What if this rally is the real deal and we're heading higher? We need a line in the sand. Let's use a hypothetical S&P 500 level of 7,000 as our trigger. If we break through that, what's the play?
The playbook is simple. The trigger is a strong close above that 7,000 mark, and you want to see a lot of trading volume to confirm it. If that happens, the action is clear. You press your bets. You add to those beaten-up software stocks, and you keep buying into that AI infrastructure theme.
But of course, we always have to think about risk. So what's the big threat that could derail this whole thing? It comes down to one thing: interest rates. The number we all need to be watching is 4.3% on the 10-year Treasury yield. That's the danger zone. So here's the defensive plan. If that 10-year yield spikes past 4.3%, especially after the next jobs report, that's your signal to act. What do? You start taking some profits off the table in tech, you raise your cash position to a safer 20%, and you make sure you hold on to your gold as a hedge.
All right, let's bring it all home. What's the final verdict? Let's summarize the day and leave you with a key piece of wisdom to carry into tomorrow. So what was today, really? It was a rebound within a larger correction, and that's a super important distinction. It tells us that last week's ugly sell-off in tech probably wasn't the beginning of a new bear market. It was much more likely just a technical event that shook out the weaker players.
And looking forward, there is one number you absolutely have to watch tomorrow: January retail sales. Why? Because if it comes in strong, it tells us the consumer is still healthy, which supports that whole soft landing idea that the market loves so much right now.
And that brings us to the final thought, and it's maybe the most important one. The news is designed to create noise and get clicks, but price action tells the truth. When you have a choice between a scary headline and $100 billion of real demand, you trust the money. You always trust the money. The best opportunities are almost always hiding right there, inside the fear.